Well, I'll say 99.5% because if I say 100, that's an awfully dangerous thing to say. There's obviously not a zero risk of something happening to push gold down. I mean, I think in the near term, the most likely thing that will cause gold to decline, and by near term, I mean the next 3-6 months. It's difficult to think that anything that's happening globally is going to make central banks say, we don't need to diversify. We're not worried about weaponization of the dollar, or people say I'm not worried about the fiscal situation anymore. I don't. So I think the reasons for the demand for gold are still here and are just going to continue.
Adrian Day returns with a sobering yet powerful take on the current macro landscape. From a slowing U.S. economy to a looming Treasury funding crisis, Adrian lays out why gold's rise is far from over. Gold rose for a fifth consecutive month, up 25.33% year-to-date, as markets reacted to shifts in tariffs, fiscal concerns, and bond market volatility. Long-term drivers such as inflation, deglobalization, and rising deficits continue to support gold's structural bull case. The foundation on which the US dollar has built its dominance as the world's reserve currency for the last 80 years is shifting, undermined by America's rising fiscal deficits and the current administration's erratic trade policies. Fiscal uncertainty in the US and other developed economies with significant debt burdens means higher bond yields, increased asset market pressure, and potentially slower economic growth, all of which are bullish for gold. Gold is seen as providing long-term value and resilience through volatility, and central banks now account for more than 20% of its global demand, up from around 10% in the 2010s. A turning point for the precious metal occurred around the time of Russia's full-scale invasion of Ukraine in February 2022, which, combined with spiking inflation and expectations of rising interest rates, spurred a flight to so-called safe haven assets. Geopolitical and economic uncertainty has remained elevated consistently since then. Adrian Day believes the same forces that have been pushing gold higher will continue, and possibly even accelerate. He says the U.S. government is heading toward a major funding crisis in the next 6 months. While this problem has been building for a while, 2025 could be the breaking point. According to Day, the Federal Reserve will likely reintroduce quantitative easing, QE, to address the crisis. And that, he says, is a significant positive for gold. We're about to explore the video, but first, be sure to subscribe and click the bell icon to stay up to date with our latest uploads. Your feedback in the comments is always appreciated.
Well, I'll say 99.5% because if I say 100, that's an awfully dangerous thing to say. There's obviously not a zero risk of something happening to push gold down. I mean, I think in the near term, the most likely thing that will cause gold to decline, and by near term, I mean the next 3-6 months, the thing that will cause gold to decline meaningfully over an extended period will be a confluence of several factors. Ukraine war ends, Middle East war or Gaza war ends, probably because there's no more Gaza, but the Gaza war ends, a China deal, and then a series of trade deals with EU and other places. Just a confluence of factors that makes people feel they don't really need gold anymore. That's the most likely thing. But on the opposite side of that, just a continuation of what we've seen certainly will continue to drive gold. And the thing we haven't talked about yet, which is the most important thing coming up over the next 6 months, is the looming funding crisis for the federal government, the U.S. federal government, because that's something that's known about. It's been known about for a while. But this year, the U.S. federal government has issued no new debt. The only debt issuance we've had this year, all year so far, is matching the maturities, the debt that's rolled off. So they haven't increased at all this year, which is really astonishing. And the longer that goes on, of course, that's why Trump is so desperate to get the debt ceiling raised. That's a different issue, but he's so desperate to get the debt ceiling raised so that they can actually issue new bonds, increase the amount of bonds issued. Because the longer it goes on, then of course the more has to be issued in a shorter period of time, which makes a successful sale or auction even less likely than if you can spread it over a whole year. And so it looks like a lot of the extraordinary measures that the government is taking, and there's been several of them, all of the tricks and techniques that every government uses, but they're all running out. And the government Besant has said, analysts have said that basically by the end of summer, the Treasury will be in a situation without the debt ceiling being raised where the US starts to run out of money. the debt ceiling will probably be raised. That's a whole different issue. We don't want to, that's a whole different issue. But even once they raise the debt ceiling, then the issue is who's going to buy the bonds at what price? I don't know about you, but I wouldn't lend the US government money 30 years at 4%, would you?
No, that term premium is a big debate, right? That term premium needs to increase dramatically to make it attractive.
Yeah, absolutely. And so if you now look at a pie chart of who is buying, not who owns, but who is buying, it's people with long-term liabilities like pension funds and insurance companies. Their buying has gone up at the long end dramatically as a percentage. Their percentage has gone up dramatically relative to, we know that most foreign banks, most foreign institutions are not buying anymore. But the biggest buyer, in my view, is going to be the Fed itself. I think the Fed is going back to QE. That's if the debt ceiling's raised and the US starts issuing longer term debt, I think it's inevitable that the Fed is going to be a major buyer. We've already seen the QT roll off dramatically from $35 billion a month to $25 billion a month, now to $5 billion. I mean, $5 billion a month on a $7 trillion balance sheet is sort of meaningless. It's a rounding error. So we're already ending. QT is basically over, whatever they say, and the Fed will start buying the bonds. That, of course, is dramatically bullish for gold.
Central banks' growing appetite for gold meant that the precious metal was the second largest global reserve asset in 2024, according to a European central bank report. Central banks' gold stockpiles are close to levels last seen in the 1960s. Combined with gold's soaring price, it is now second only to the US dollar as the world's largest reserve holding in value terms. In 2023, gold and the euro were roughly equal in share at around 16.5% of global official reserves on average, according to a CNBC calculation based on ECB data. In 2024, the share shifted to 16% for the euro and 19% for gold, with the US dollar accounting for 47%. Adrian Day emphasized that nothing in 2024 has happened to convince foreign central banks that everything's fine now. On the contrary, he believes the dollar's decline in global reserves is likely to continue, and that's bullish for gold. Now let's redirect our attention to a video.
Certainly at the beginning of that period, central banks buying, as you know, has dropped off a little bit or got a little bit soft, still on a quarterly basis, meaningfully higher than what it was 3 years ago and prior, but lower than it was last year and the year before. So certainly central bank buying has been the main driver over the last 12 months. And then the other factor would be Chinese consumer buying, Chinese non-official buying. A lot of concern, which has really picked up in the last, 6-8 months. A lot of Chinese are concerned about a devaluation in the yuan. They want to protect themselves against that. The banking system is kind of fragile, and apart from that, putting your money into the bank doesn't protect you against a devaluation. And they're not allowed to buy crypto. And only the foolhardy would buy real estate. And so basically gold is gold ETFs pretty much for the last year. And then we're starting to see those pick up in North America. And that's a concern about, global fiscal, the US, but other countries as well, fiscal situation around the world. But I think all those things are likely to continue. Obviously they ebb and flow. And we had an ebb in central bank buying last summer, if you remember, the beginning of last summer. It dipped significantly. So each of those individual things will ebb and flow, but on balance for the next year or two, I don't think the situation in Ukraine or in the Middle East is a huge driver in gold, frankly. And so it's obviously a positive for gold as opposed to a negative for gold, but I don't think it's a huge driver. And so reversing those two situations, which I think we all hope and pray will happen, I don't think that will be devastating for gold. It might be, peace in Ukraine, for example, might be the trigger that causes an otherwise overvalued gold market to correct, but I don't think in and of itself it's a meaningful factor in driving the gold price. Again, I mean, if you look at central banks, for example, if you go back to the beginning of this century, global central banks had about 75% of their foreign reserves in the US dollar. And that's slowly come down over the last quarter century. 5 years ago, I think it was at around 65, 68%. It's now at 58%, last numbers I saw. So the trend has continued and accelerated. How long will that trend continue for? I don't know. Maybe just when they get to 50%, that will be enough. But if you're concerned about the US fiscal situation and you're concerned about dollar weaponization, I would have thought you want to just continue reducing that allocation to the dollar. So the urgency is less today than it was 3 years ago, and at 50%, the urgency will be less. But I think that trend is just going to continue, frankly. Nothing that's happened in the US this year would make foreign central banks say, we don't need to get out of the dollar anymore. Everything's fine. On the contrary, right?
Gold's rally shows no signs of slowing, as deep-rooted macroeconomic shifts continue to unfold. Rising U.S. fiscal deficits, structural inflation, and growing geopolitical instability are all driving demand for the precious metal. With central banks ramping up their gold reserves to levels not seen since the 1960s, and the dollar's share of global reserves slipping, gold has firmly established itself as the second most significant global reserve asset. Market volatility, higher bond yields, and looming funding pressures in major economies further reinforce gold's appeal as a long-term store of value. As deglobalization accelerates and quantitative easing looms on the horizon, gold's structural bull case appears more intact than ever. As trust in the global financial system declines, do you see gold as the last true safe haven asset? Join the conversation. Share your thoughts in the comments. Give us a thumbs up if you found value in this video and subscribe to stay engaged with our community.